Capital gains tax, the rates are going down. Basic rate taxpayer 18 to 10, higher rate 28 to 20. Entrepreneurs relief remains at 10%. Rate of capital gains tax on residential property is still going to be the 18% or 28% rates. There's going to be new entrepreneurs relief, 10% rate of tax on shares in private companies that are subscribed for, that are held for at least 3 years and issued after the 17th of March. You don't need to be a director and you don't need to hold more than 5%. And there's going to be a £10 million lifetime limit. Entrepreneurs relief is going to be backdated, but it looks like it only works if you own less than 5% of the buyer. Now, the original proposal meant that interest in a partnership didn't qualify for entrepreneurs relief. They're now changing the rule back again so that they will, provided that the individual has an effective 5% interest in the partnership. After 6th of April 2016, if you liquidate a company and within 2 years you are involved in a similar trade as a sole trader or through a company in which you or a connected person holds shares, and you do it for tax avoidance purpose, then the liquidation proceeds are retrospectively taxed as income. If you're a basic rate taxpayer, paying tax at 20%, you go from 0 to 7.5%, 40% band from 25 to 32, and the additional rate from 30 to 38%. You're still better off taking a dividend than a bonus. Not quite so much better off, but nevertheless, unfortunately, there's not really a great deal that you can do about it at the moment. One thing you can do, of course, is to do a little bit of planning for your dividends. You're clearly better off getting them this year instead of next year if they will be taxed at a higher rate next year than this year. Pension tax relief costs the government about £34 billion each year. The tax on pensions is about £13 billion. So the net loss to the government on the tax relief on pensions is the difference between those two. It's quite a big number. At the moment, the arrangement we have in this country is you get relief for the contributions, there's tax-free income in the fund, and you pay tax on the pension when you get it out. Nice and simple. Tax relief in, tax on the way out. The favourite alternative system, which is used in other countries, is you don't get any relief when you put the contributions in. The money in the fund is tax-free, and there's no tax on the pension when it's paid out, as you would expect. A sort of super ISA type of arrangement. The problem you have, of course, is if you wanted to change from one system to the other. It's quite simple for a defined benefit system, a bit more difficult for a final salary scheme, also a bit more complicated for public sector because it doesn't actually have a pension fund. You've also got two systems if you wanted to switch from one to the other. On the one hand, people have had relief for paying contributions to the old scheme, so you'd want to collect tax on the payments out of those, and only the new fund schemes would come out tax-free. At the moment, you tax the payouts from people's old scheme. What if you said to them, you've got £300,000 in your old-style pension scheme, give me 10% or 15%, and I'll convert it to a new scheme so you can take the money out tax-free. From the government's point of view, of course, it's a huge amount of money coming into the public coffers in 1 year. Okay, that reduces their tax take in the future years, but then that's the next government's problem. So you don't think that far ahead. So quite a useful little earner for the government, actually, if you think about it. Pension contributions and funds are already being severely restricted. When this pension pot legislation came in, there's a limit on the size of the pension fund you can have. It was £1.75 million. It's now coming down to £1 million. In real terms, that equates to £750,000 in 2006, I think it was, when it came in. So the size of the pot that you can have it in real terms has already come down by significantly over 50%. So there's already a substantial reduction in the amount of relief given for pensions over the last 10 years. Limits on contributions as well. We've now got a £40,000 annual limit which can be carried forward for up to 3 years. If your income's over £150,000, including pension contributions, there's a restriction of £1 for every £2. Once you're up to £210,000, contribution limits are £10,000. However, if you do have money in a pension fund and you can afford to, the best thing to do is to leave it there. Because money in a pension fund is inheritance tax free. If you have a pension fund that you can effectively control, you're far better to spend your capital and leave your money in your pension fund where it will remain IHT free. You remember I talked to you about the possibility of an ISA, some sort of super ISA replacing a pension fund. Well, I wonder if the chance is sort of going in that direction in tiny steps. He's now introduced the ISA limit to £20,000. And if you're under 40, if you save 4,000, the government puts in another £1,000. For those of you who are not domiciled in the UK or who have a friend who isn't, this makes potentially a big difference to you. From 2017, you're deemed domicile after 15 years of residence. That applies for inheritance tax, capital gains tax and income tax, but not for the purposes of general law. There are various general legal matters that are affected by your domicile, things like in wills and that sort of thing, and probate. They are not affected. It also doesn't affect a trust that a non-domiciled person settles before he is deemed to be domiciled, unless he is what is called a returning domicile. If you were domiciled in the UK, moved your domicile, and then become resident in the UK, whilst maintaining that you've moved your domicile, then you're caught. If you've got 3 houses, it's relatively, and you're prepared to spread your time between the 3 of them, it's relatively easy not to be resident anywhere. There is no rule that says you have to be resident anywhere for tax purposes, just as there is no rule that says you can only be you are only resident in one country for tax purposes. So judicious spreading of your time between 3 properties, you can relatively easily not be resident anywhere. Gets a bit more tricky if you've only got the 2. You have to balance things a bit more delicately. And obviously really only applies, well, it doesn't apply if you've got a full-time job, clearly. So works well if you're retired or you're in business independently. You have a lot of control over how you run your affairs, but not necessarily for everybody else.